Always, we're sponsored by Jasmine Mortgage Team, and we're here talking about more real estate investing, how to get started. A lot of folks excited about real estate. They want to go buy that first property or their second or their third, and they just don't know how to afford it. So that's what we're getting into today. Typically you have two options. Go get a mortgage if you can. Residential mortgage. Jasmine Mortgage Team sponsors and helps real estate investors buy the single family, duplex, triplex, quadruplex, the small multifamily. But what if you're looking at something bigger, maybe 5 units or more? That is what we're going to talk about today, how to get financing for those sort of things. You typically have to go get money from a bank or a mortgage company, or maybe you partner, pool private funds, which we've talked in different episodes. But here we're specifically going to talk about the bigger units. They're called commercial. All right. It's residential commercial, which is weird, or commercial residential, I should say. 5 units or more cannot be funded by a typical residential mortgage company. And we're going to get into why that is and what that looks like. And also, if you are buying real estate under the name of an LLC, you also have to go to get a business loan, a commercial loan, because now you're a business, you're an LLC. You can't get a personal mortgage, residential mortgage in an LLC name. That's under your personal name. So at some point, you're going to want to make that switch from buying in your personal name into an LLC name. When that is, there's no one size fits all. A lot of people get stuck on that, and I've worked with real estate investors, and they didn't want to go looking because they haven't thought of the best LLC name yet, and that's just crazy to me. Don't make that mistake. Just get started. You can always buy something under your under your personal name using a residential mortgage if you qualify, and then you can switch it to an LLC later. Doing the reverse is a little bit more difficult, buying an LLC and then going residential. So don't get hung up on what your LLC name is. Also, no one will ever see the name of your LLC, so it doesn't need to be something creative. The only person that sees it is the closing attorney at the table who has to make the documents, and the bank who's giving you the mortgage. Like, it's not advertised anywhere. You can do business DBA under another name. So that first, second, third, any LLC name, the creative naming is not a requirement, and it should not be the hiccup to getting you started in real estate. A lot of people say, well, what if I get sued? I don't want to put things under my personal name. Well, there's insurance for that. It's called umbrella insurance. So you get property insurance if you do buy it under your name, but then you can also get something called umbrella insurance that covers everything else outside of that. So there are ways to protect yourself through an LLC, and we're going to talk to our guest today who knows all the ins and outs of that. Mark Ritter is going to be joining us, markritter.com. He gives financing to real estate investors if you find yourself in that situation. If you're investing in an LLC, he gives loans through a credit union. We're going to discuss what credit unions do and how they can help you, because you're only going to go as far as the money you can raise or the money you can get lent in real estate investing. So you want to know all the tools available to you. I always say the more tools you have in your tool belt, the further you're going to progress as a real estate career. And you're going to need to know your residential mortgage, Jasmine Mortgage Team. You're going to need to know your commercial lender. We're going to talk to Mark Ritter today about that. You're going to need to know your hard money lenders. These are the guys that aren't at a bank. They just have a lot of money to lend out. You're going to need to know, partners that maybe have some capital that they'll partner with you in deals. These are all tools to financing. So that's why I'm excited to bring Mark Ritter into the show today. Hey, Mark, thanks for joining us.
Thanks for having me. Looking forward to the conversation.
So kind of walk me through a little bit where you're based and what you do.
Sure. My name is Mark Ritter. I am the CEO of Member Business Financial Services. I never call it that. We just say MBFS. And MBFS is a company that's owned by 12 credit unions. And we work with about 80 credit unions all throughout the country, and particularly in the Southeast United States and Mid-Atlantic, where I'm at. And we have really one mission in mind, and that's to bring real estate investment financing to credit union members. And credit unions have only really been in the business commercial side for about 25 years in any meaningful way. So the easiest way to think about us is what the credit union said is that instead of everybody going this whole buying all the infrastructure needed to create commercial lending, hiring all the credit analysts and documentations and systems, we're a back end operation that helps bring that to credit unions. But we also have 13 lenders scattered throughout the country and work with the credit unions and investors to bring those loans a little bit better, cheaper, faster, easier than if all the credit unions did it themselves.
So real quick, what's the difference between a credit union and a bank?
Sure. This is the hardest part of my job and the reason why we like to spread the word on shows like this. And if you're driving up and down your street, you probably pass a bank and then you might pass a credit union. They're all over the place. There's 5,000 of them in America, and they have drive-throughs, they have ATMs, they have a sign up that says, come get your checking account, an auto loan, and money's fungible. My auto loan from a credit union spends the same as it does from a bank. But what really is the separator between the two is the corporate structure between the two and the philosophies on how they operate. And what a credit union is, it is by definition a not-for-profit financial co-op. So it's owned by the people who have accounts there. It's operated for the people who have accounts there. And it's run by a board of directors elected by the people who have accounts there. So that rolls over to you tend to have a little bit easier seat at the table, particularly if you're just starting out in this business.
So a bank co-op, when I hear that to me, it sounds like possibly a cheaper lending experience. Is there benefits?
Yeah, I always say, I always joke that if I went to a bank, I haven't worked in a bank in over 25 years. And if I did, I'd probably get fired the first week because I tend to be a little bit more casual and conversational and try to come up with something that's win-win for people. So when you're a cooperative financial institution, you aren't as you still need to make money. We're a federally regulated industry, but you don't have to focus on, gee, I need to build this particular fee income bucket, or I got to maximize this. You can tend to have a little bit lower fees. You can tend to have a little bit better better rates if you're paying. And one of the unique things about the business side is at a bank, many times you're locked into prepayment penalties and your rate is your rate for an extended period of time. And people don't particularly know that until they go refinance their loans. But at a credit union, a federal credit union does not have a prepayment penalty. So we tend to be a little bit more flexible and approachable.
Yeah, no, that's definitely a benefit. And like you said, you have to be a member of the co-op. So
Yep.
I'll throw this. We'll start talking about LLCs in a minute. But most banks, whether it's a typical traditional bank or a credit union, you're going to have to do your LLC's banking at that bank to get the best rates. At a co-op, the credit union, is that the only way to get loans? Is if you open up an account there, or you get the best rate?
Much like any cooperative, you have to be a member of the cooperative. And I remember, when I was growing up, my dad was a member of the credit at his factory's credit union. And back in the old days, it was if you were with this particular government office or if you were a school teacher, and they tended to be very narrow in definition. Particularly in Georgia and the Atlanta area, if you're driving past a credit union these days, probably 9.5 times out of 10, you can go in and open an account with a very low barrier to entry. It's not, at once was a kind of a pain, and you had it, but they're either community chartered or have a fairly open group that you can join, and you can use the services of the credit union. And you don't have to open that account generally till you're approved for the loan and you're working towards the closing.
Yeah, 100%. I've gotten quotes from credit unions before, and they basically said, "Hey, this is going to be the rates. This is going to be the down payment. You're just going to have to open an account the day we close on this loan." So it wasn't something where I had to go open an account and then talk to them about mortgages. So don't let that be a barrier to kind of getting quotes out there. A couple of things, pros and cons. I'll throw this out there. Working with a bunch of credit unions in the past for my clients, but also for myself. It's a tremendous customer service. I feel like everyone was so friendly and nice and down to earth, and generally engaging and wanting to help me on things. Con, I felt like the closings, everything just moved a little bit slower. It was just a slower pace of things sometimes. So I'm not saying everyone works the same way. That's just my personal experience, but I'm throwing that out there. If you're wanting to do, got someone under contract, you got to close next week. Credit union might be tough for that because it's a different beast. But I don't know if you've experienced that as well, Mark.
Yeah, absolutely. That first deal that you do with a credit union is not going to be your fast money close. And what I always say, it's kind of like that eighth grade dance. We're all kind of staring at each other and nobody knows what to do. And that first one is we're trying to go through the process. And you mentioned hard money lenders and credit unions. And I really think we both have our places in this world. Hard money lenders are great for that quick close. You want it done quick, fast, easy, but you also pay for it.
Mm-hmm.
And then once that property is stabilized, it's fixed up, it's renovated, we take out a lot of hard money lenders once you get through that process. And in today's crazy world with appraisers, oh heck, you could be into getting a licensed appraisal in 6 and 8 weeks, and it can really bog things down. So I would agree with that.
Okay, so LLC, investing with an LLC. If you're listening, you don't know, it's $150. You just go to your Secretary of State website, create a new LLC. You fill out like 6 questions, your address, who's running it, and then you pay your $150, and it's like, congratulations, you have an LLC. That's what it takes to create an LLC. So a lot of people are very overwhelmed by that. You don't need an attorney. Maybe if you have multiple partners and you want to create an operating agreement that's well received for everyone, yeah, go ahead and do that. But if it's just you and your spouse, then you can spend $150 on the website and just do it yourself. So, and again, you could do that a week before the closing. You don't have to do that before you even go look at properties. LLC, what sort of are you looking for to approve a real estate investor that's created an LLC and they want to buy a property? And
sure,
Mark, I know you're not directly the lender. You represent 14 credit unions. Is that correct?
Yeah, we're actually doing these deals for about 80 credit unions.
80. Okay. Wow.
Last May, as we record this, it's June. In May, we did about $60 million in real estate investments.
Okay.
For various people. So yeah, we see this a lot, and I would say 15, 20 years ago, the vast majority of loans that we saw for residential investors were just in somebody's name, and it was just the person they bought property and that was it. The big changes that we've seen are the tax laws. Not an accountant, but it tends to be more favorable as you go along for on the tax side to split it up. So that's one of the nice pieces with it, as opposed to folding it in. And when you form that LLC, people need to remember that it is that startup business function. So, but what we're really looking at is you. We really want to make sure you're there. You know what you're doing. It's a property that makes sense from a real estate investment standpoint. So, if you just go form your business today and you go start applying for loans saying I have an LLC, we really are going to take a look at the person behind it. And I'll give myself as a good example. I have couple real estate investments. I outsource everything because I can barely change a light bulb. I'm horrible at it. So we want to know who's behind it and what's your plan and how we can help you grow. And also, there's a big difference between somebody who's maybe in the real estate industry and you're naturally acquiring these properties. Maybe you're an executive like myself, and this is a part-time venture for a long term. Or if you just quit your job on a Monday and said, I'm going to be a real estate investor, and I'm going to start making money, that scares the heck out of me because I need to know that you can pay your bills for the next few months until you get these ramped up because, in today's market, it can get really tight and it's going to take a while for you to grow that cash flow.
So let me jump onto that. So you're creating an LLC. This is a business. You're buying a house, which is basically real estate investment, which is basically a small business, right? It's good.
Yeah.
The purpose of purchasing this is to generate income. But what I'm hearing is that, but you're really still, even though this is the operation, you're still looking at the person in the LLC. Are you looking at their personal finances, their credit score, their liquidity, all that as well?
Yeah, and there's really that sliding scale for when you're first starting out in that first one or two properties. We're probably looking, 85% at you to make sure you're stable, and maybe 15%. Do you know how to run this property, and is it a good deal? And then as you mature in your life cycle, then it will go on a little bit. Then it'll be a little bit more 50-50. And then even looking at that business a little bit more. So particularly when you first start out, that's where we're going to be looking most at you. And that's why I really like credit unions, and what we do is because we will give people a good quality rates and terms at that at that program, because we're really looking on it from that on the cooperative side. And there's over 125 million people in America who belong to credit unions. Well, who's best to help get you through that first deal? And maybe it's that person, it's that place where you have your account, where they've known you paid off a few loans, you have a good deposit history. They see maybe your paycheck coming in and out, and you're established, where they're a great fit for that first deal or two.
Yeah, every time I've had to get any commercial loan, not just through a credit union, I've had to write a one-page document of my experience and history. Like it's like a resume. They want to know a little bit about you. And also, I've learned over the years that repeat business, it gets easier and easier. I don't recommend that at any of the big national chains, the Bank of America, Wells Fargo, Chase, those sort of massive organizations. They don't really pay attention to you until you've got hundreds of millions on deposit. But a credit union or a small community bank, they really appreciate your business. They really want to help you grow. They can get really creative, and the more they know you, the more business you bring them, sort of the deals get a little bit more attractive over time. So I definitely agree with that statement. So what does a person do in this situation? Like, they've maxed out what they could get on the residential loan side, whether through it's their income, through their debt to income ratio. The traditional mortgage companies saying, hey, we can't give you any more money unless you get a massive raise or bonus or anything like that, or because that's what happened to me. And that's when I started getting into the commercial. I was like, okay, well, now I've maxed out that tool. Let me try to get into the commercial and credit union. Are there creative ways or ways to still get funded if personally I haven't done any deal with you, but I have a successful track record through residential mortgages, and also I might be a little tight on funds?
Absolutely. And that's really where we have the flexibility. You mentioned some of the big, you have in the greater Atlanta area, you have some mega lenders. And that's they spit the numbers in a computer, and either comes out yes or no. Whereas we want to know that we can work with you for that relationship. And what we're really focusing on is that global perspective. I have a sister company that's owned by many of my same credit unions that does residential mortgages. And as you know, that there's standards, there's rules, there's regs. Here's what it has to be. You got to have the debt to income, and you have to move on. And sometimes they're looking at the past. That's probably the biggest difference is the residential companies tend to look at the past, whereas we look at the future. And our credit people, God bless them, they do this all day, every day. They're really kind of taking a snapshot of the person that you are now, but then we globalize it with the business and make projections about what that property is going to be like in the future and what you're going to be looking like in the future, instead of just, hey, you're buying a property, we're going to take that mortgage and pop it on your personal debt schedule. Well, a lot of people don't look good in that scenario unless you just have a massive income. So we're really looking at that on a global perspective, as opposed and looking at it as you personally and the business and what the market's like, and isn't it reasonable to project out that you'll be able to pay us back. Ultimately, the hard money guys, they want to go, they're going to do that. If you don't pay it, they're going to take your stuff. We want your success is our success. So if we're coming back at somebody with questions, it's just that we're coming up a little bit short on showing that you can comfortably pay this back. And sometimes a tool like that is a great resource and tool for people, because we have no problem having people look under the covers to see our work. And you can tell us where we're right, tell us where we're wrong. Maybe we're missing something, because it's much more of an art project in my world than a science. I mean, people always say, do you finance, blank, fill in the blank? And the answer is absolutely we do. We'll look at the single families, we'll look at the 4 units, we'll look at 5 units, we'll look at mixed use, because that's the world that we live in. And it's not the same terms as what people can get on the residential side. And sometimes that's a little bit of a shock to people, maybe when they're making that transition. The other piece that we do, maybe you're having a successful business, but you can't afford to put 20, 25, 30% down on everyone, but you have some equity in other properties. We really have worked with people to mix and match some properties and pull some money from the equity that you have in other areas and do some refinance to make it work.
Yeah. So I've heard that referred to as a portfolio loan, blanket loan. And that's where the creative financing gets started, and sort of the business side, commercial lending sort of things. And like Mark just said, you say you have 5 properties with $100,000 of equity across them all, 20,000 here, 20,000 here, 20,000 here. Then you can get a blanket loan that sort of encompasses, so you can access that entire $100,000 off of those 5 properties, and then use that $100,000 equity as down payment on the 6th property. And so, is that accurate? Is that how you?
Absolutely. And that's where it gets to the point of, sometimes that perception of a little bit slower. But we really will have that conversation and then go back with you and trying to structure that deal that makes sense for you, that makes sense for us. So we can move some things around and really help people get through the process, as opposed to just saying no.
Yeah. So let's talk about terms. So I'll tell you the advice I give, and then you correct me or if I'm wrong, and also let me know if it's out of date. But typically I say commercial loans are going to be about 1% higher than what you're seeing on the residential side, and maybe 1 point more, like 1% of the loan amount extra in closing fees. Is that still sort of a good estimate, ballpark?
Yep. Yeah, absolutely. And I could walk through some of what it looks like today if you like.
Yeah, sure.
Typically the biggest change from looking at a residential mortgage where you're getting a 20 to 30 year fixed rate loan and that's what you have, those are really almost out the door in the commercial side. And the main difference sometimes is you have to look at where the money is being funded from. Many time in the residential side, people make a loan, it conforms to the market, and then you can take that loan and sell it to the secondary market, where then it's sold into bond funds and securitizations and things like that. Under the commercial side, in 98% of the cases, that loan is being funded by the local institution, whether it be a community bank or a credit union, and it is staying with them. So they're really holding that interest rate risk because they're using their money to hold that loan. So in today's world, you're going to get like our typical terms would be 5-year fixed. And then the loans are usually about a 15-year term altogether, and the rates adjust every 5 years. And then maybe the amortization is up to 20 years if your property has some age to it, maybe up to 30 years if it's a new sparkly property that's in really good condition. But yeah, those five, and what we usually see is most real estate investors, the loans usually stay on the books for about 4 to 5 years anyway, because what are you doing? You're upgrading your property. You're pocketing the equity and selling it. You're refinancing it so you can go buy new properties. So I would not want these loans for my house because, I plan on living in my house for a long time. But under the investor side, those adjustable rates usually work out pretty well. The one piece that people need to understand is that when you go get a residential mortgage, all the rules and laws are in your favor. And that's why, you've sat through it thousands of times where there's the disclosures after disclosures after disclosures and protections. And in a commercial side, the law kind of shifts and says that you know what you're doing and you understand what you're doing. So there's all the disclosures and laws. So you better read the documents and understand the terms that you're getting from that lender, because the laws don't protect you. And luckily, I'm in an industry that's very friendly to our people, but not all commercial loans are created equally. And sometimes those back-end terms can be very onerous. And what we found out is a couple years ago, when rates plummeted, people tried to refinance, and many people that we worked with quickly found out they were locked into prepayments and had to pay a very large penalty to get out of their existing loan. And under the residential side, you never see or even come across anything remotely like that.
Right. Now, I think that's good to count. What you started with saying how, most commercial loans have sort of a 5-year fixed aspect, or a 5-year arm, or even sometimes a 5-year balloon in some cases. And I know real estate investors listening here is thinking, why would I do that? Why would I want that 30-year? Well, why residential is 30-year fixed? Like, that's what I want. And this is what I want to drive home. Like Mark made a really good point here. When you get into sort of real estate investing at this level in the commercial space, you're buying the bigger buildings, the 5 units or more. You're using a credit union through Mark Ritter for your financing because you've maxed out your residential loans at Jasmine Mortgage Team. You are wanting to use that equity as much as possible. Like sitting on equity is holding a lot of real estate investors back. And what I mean by that is, hey, I'm locked in this 3% interest rate on a 30-year mortgage. And I've paid off 70% of it. But when I hear that, I'm like, well, you've got, let's say that 70% equates to $500,000. I was like, great. So you've got $500,000 not working for you. It's just sitting there. It's not earning any money. Commercial investors and lenders and stuff are thinking, when I every dollar that's not working for me is my business is failing. And so typically over that first 5 year term, they're adding things to increase the price of the property, whether it's, adding washers and dryers to the unit so you can charge higher rent, charging for parking, adding storage units to the basement, whatever it may be. All those things increase the value of the property, because the way that a commercial property is being appraised is one thing: how much money does it make? It doesn't really care about the other 20 unit buildings in the neighborhood and what they're doing. They're looking at this one small business. You can't really do that on the residential side because the appraisals are based to other like kind properties. So if you've got a triplex, they're going to say, well, what's the other triplex selling for? And the appraisal will say, well, this is what the other triplex sold for, even though you might be doubling the income on your property than that other one. It's a different way to appraise the property. Commercial, it's how much money can this make? Let's make as much money as possible because that increases the value. Get an appraisal in 5 years, do a cash out refi, pull out that money and go deploy it in another property, rinse and repeat. And so you're just not sitting idle on things on the commercial side. So that took me a long time to overcome and to realize, like, why are these things sort of 3 year, 5 year terms? And now I get it. Now that I've been in sort of the commercial side of things for a while, it's not the best use of your money to have it just sitting in the property earning equity.
When it comes to me personally, I don't want to carry credit card balances. I want to pay off my cars, and I want to work towards paying off that mortgage and be debt free. To me personally, that is a great aspiration. When it comes to the real estate investment side, the most successful lenders that we work with, they are doing exactly what you're saying. They are maximizing their equity. They're maximizing their leverage. They're taking that property that they bought right, selling it, cash out, and then leverage that money into a larger property or maybe a 10 to 20 unit property. They're not just simply sitting on it, paying down and saying, oh, I have a portfolio of properties with zero debt. Is there a balance there? Absolutely. You don't want to get caught upside down, and you want to give yourself cushions for the marketplace. But so there is responsible use of debt, but it is very much putting on two different caps for your personal life compared to your commercial and investment life.
Yeah, I think you nailed it, Mark, because in your primary residence, your credit cards, that's in the name Mark Ritter. Your house, Mark Ritter. Maybe you've got one or two properties that you got through a residential mortgage in the name of Mark Ritter. I get wanting to pay those down, to get those debts off my personal name. But then the other thing is like, hey, this is an LLC. These are debts in an LLC name. And there is a point at some point where you can get mine, like it's called a non-recourse. Can you talk about the difference between a recourse loan and a non-recourse loan, where basically I get my name off of the debt within this LLC and I'm not a personal guarantee?
Absolutely. And what I always tell people is you have to remember there's a big universe in commercial lending, and it's not a homogenous industry like you're going and getting a credit card or a car loan. And when you start out, we're like I said, we're looking at you. Because if you walk away from that property, we want to make sure you're behind it. As you grow, as you get into larger, more complex deals, as you start to establish yourself more, then you can look at what we call recourse and then non-recourse. I'll describe recourse as very simply. You're going to give me a personal guarantee that says, if this loan goes bad, you're going to stand behind it personally, i.e., I come take all your stuff, even though the market went bad. And during the Great Recession, a lot of real estate investors learned what the difference between recourse and non-recourse lending is. In a non-recourse lending, your business stands on that deal by themselves, and the business cash flows by themselves personally. And I'll give the best example is if I go finance a Walmart Plaza, Walmart is paying the landlord each month, and then the landlord gives me the check. I'm not too concerned about what that landlord is doing each month, because Walmart's going to give them the check and then indirectly pass that through me. So as you graduate, as you mature, there's non-recourse loans out there. Now there's kind of, when do you jump into that? And it's really what we look at it to say, if you stepped away from this business and just walked away, would your business still go and establish? And you, when you have that management company and it stands on its own, if your business can't stand on its own, you might be able to find a non-recourse loan out there, but I can tell you, you're probably going to be paying 2 to 3 times the interest rate if you jump over to that side a little too early. So that's kind of, as a lender, when you start out, you're giving me a recourse loan. If you want a non-recourse loan, thank you, go somewhere else. And then you can graduate. And then there's that extreme higher end where almost everything we do is a non-recourse loan.
Yeah. And that if you want to be a full-time real estate investor, that is sort of the progression you want to make. Because when you're starting out, you're limited to what your income is when you're getting sort of residential mortgages, and then you sort of graduate up to commercial loans. Things are a little bit more expensive, but they're going to look at the deal a little bit more than they do into your personal finances. You're still considered. This is the recourse part of the loan. And then once you've sort of proven yourself to everyone that you know what you're doing and your businesses are making money, and your businesses being your LLC that's got this property, then you could refinance into non-recourse loan. And that is why that sort of massive refinance of every 5 years kicks in, because you want to pull every single dollar out. It doesn't affect you personally. It only affects that business, that's standalone LLC. And no one's going to give you a mortgage if that business / LLC / property can't pay for itself on its own without you. And then that's why you go deploy more and more cash after that. It's sort of a progression. How long does that usually take? Is it number of properties? Is it the price point? What do you see, Mark?
Yeah, we see it off of type of properties. It may be a 5 to 7 year period with some people, maybe even up to 10 years. It depends really on how much you want to ramp up the business. If real estate investments is just a part-time venture for you, supplementing maybe your long-term plans or a little bit of cash flow, you're probably going to be in that recourse world, but you can get very good rates. But beyond that, it might be into that 4 to 7 to 10 year period till you look at it. And really, the key for that as a lender is we want to know who is paying back the mortgage. If it's a large multifamily unit, our risk is spread across a lot of units. If it's a retail unit, like I said, if Walmart's paying me, I don't care. If corner hairdresser is paying me, where they might be in and out of business every 2 years with a new company in there, I'm going to dig into that a little bit more because your tenant strength just isn't there.
Yeah, and that's also reflected in the interest rates. If you're buying a CVS or a Chase Bank or something that's corporate backed, which means the headquarters of Chase or CVS or is the tenant, you can get interest rates at 2-3% on these things because it's very, very low risk. On the same side, they're also not paying market rate. Sometimes they also pay slightly cheaper rent because it's such a safe bet. Like everything in real estate investing, the more risk, more reward. But yeah, corner hair salon, if you try to get an LLC, a loan based on that property, you're probably going to charge them a higher rate, or you're going to get a higher interest rate, or you're going to have to do recourse, which means you're personally backing it as well. Just because no knock on that hair salon, but they're maybe new to business. They only have 1 or 2 properties. It's very family owned. If the proprietor passes away or decides they don't want a haircut anymore, this business may fall apart. So that's obviously more risk. So you can charge them more rent. Your interest rate is going to be a little bit higher. So this is to me, I always look like a lender is your partner, your guiding light in this ways. If they think it's risky, you should consider it risky. If they think it's safe, then it's typically going to be very, very safe investment, but you also get paid accordingly for that.
Yeah, one of the things that probably the biggest mistake that I see people make, particularly when they start out, is they treat every lender as just this homogenous industry. When lenders, we help a lot of people. We do the smallest of deals. We've done small single family unit properties. And this year we did a $38 million commercial warehouse. And that's a big world in between there. But lenders are not homogenous. You have some people who specialize in non-recourse lending. You have people who only do recourse lending. You'll have some people, they only do residential, they only do commercial. So you really, once you start getting into this commercial world, it's not it's the Wild West in terms of the rules and what people can offer, and really do the research on who your lender is. Where do they get their financing from? Because where your lender gets their money from in the commercial side makes a massive difference. So make sure you're doing your research and you understand who they are. Get references, because it's okay to interview them and talk through the process of who they are, so to make sure you don't get disappointed in the long run.
Now, it's my understanding that banks have to lend a certain percentage of their loans out to someone within a radius of that office. Do credit unions operate the same way?
What you're referring to is the Community Reinvestment Act. And credit unions are exempt from the Community Reinvestment Act. And the reason Congress did that is credit unions, by their nature, lend in the markets that they have loans in. And that because they are working with field of memberships in communities. So that's why if you're seeing a credit union that's in your neighborhood that you drive by, they want to lend in that neighborhood. Whereas the banks may have a tower in downtown Atlanta, but historically they might not have lended there and put it in different marketplaces. So, yep, that's why the credit unions, the philosophical difference is a little bit.
Got it. And then another thing I want to talk about is partners. So there's a lot of people get into real estate through partnerships. Maybe you partner with a contractor or someone who has money, or you're just two like-minded souls who want to get into real estate investing together. And I usually recommend you can kind of get away with real estate investing with a partner if it's just two people total in the residential mortgage side, meaning 4 units or fewer, because then they're just doing two different credit checks, but it goes against your personal debt to income ratio. But typically, if you're going to get a partnership, 3 or more, I always say go to the LLC route, form an LLC, get a proper joint venture agreement or operating agreement made between the 3 of you, and then go get commercial lending. How do you guys look at partners? Is it like, does all 3 have to qualify if one has a bad credit score or 2 have low income? How do you sort of create an overall lending package for a trio of different investors?
It is a massively more complex situation. And typically what we find is that people have different roles in the organization. And you may have a, quote, money guy who's just an investor who doesn't want to get the call when a tenant's toilet is broken on a Saturday night. And then you'll have maybe the operating people or somebody who's the real estate agent who's going to be filling up the units and act as that operator. So what we're really looking for are what are the different roles and responsibilities. One of the big changes when you bring in people, there was always a stance of whoever the money guy is, he's just getting in his money and that's it. With the whole new know your customer and banking and regulations, even if that person doesn't want to be involved in the transaction as a guarantor, there's going to be due diligence on everybody because, quite frankly, the federal government wants to know where money is coming from on for investments and loans, so nothing nefarious is going on. So you have a little bit more negotiation in terms of the guarantees. And sometimes what we'll see is those personal guarantees be negotiated. Because always remember, this is not the residential mortgage business. This can be negotiated. So if everybody has a full and unlimited guarantee, what's going to happen is the bank or credit union is going to go knock on the door, whoever has the most money. Mm-hmm. So you can limit guarantees, you can negotiate them. There's different terms and some scenarios to limit people's personal liability, the more people you get involved in the project.
And I think as we're mentioning, like, it doesn't go on your credit score. So even if you are a personal guarantee, if you are recourse on a commercial loan LLC, and then you go buy a primary residence, that doesn't show up on that primary residence mortgage application at all. What you're doing on the LLC side, the commercial side, your personal guarantees, that's off the radar. So don't let this like. A lot of people are like, well, I'm going to go buy my primary before I get in commercial investing and stuff. And I'm saying that there's no overlap. Like there's overlap maybe in your personal funds, but it's not showing up in your credit score. It's not showing up in your debt to income ratio because, again, you're lending in an LLC, which is completely different than lending in your personal name.
Our borrower is the LLC, and the personal guarantee is not a recorded transaction. The only thing you're going to see is if somebody pulls your credit, they could see that there was this inquiry over by this other organization, which realistically has very little impact, and you can move on and you can build that wall between the two.
All right. So Mark Ritter, you said 80 credit unions you sort of represent, the broker. So if you reach out to Mark and then Mark sort of finds that best package, because every lender has their own sort of, unique niches. Where do you lend right now?
So we've lent, we are heaviest in the East Coast, all throughout the mid-Atlantic states, all up and down the coast. We have a ton of clients in Florida, Georgia, and Alabama. And we do more a little bit more in the central time zone, not so much out west. But what we do is actually, if you have any listeners and they're in an area where I don't have a direct client, we have relationships all over the United States with credit unions where we match people up with somebody who would be a good fit, and you can have access to that local credit union who's doing real estate investments.
And so you're a mortgage broker, is that sort of your title?
Yeah, except we don't get paid for brokering loans. So we just really try to help people out and get them matched up with a local lender. We're what's called a credit union service organization. So, we're really just put together to get people doing these loans a little bit easier, cheaper. And then they get the loans directly with the credit unions who are our owners and clients.
So what I hear when I see this is I can call Mark Ritter and he's going to call 80 banks on my behalf rather than me having to call 80 banks directly myself.
Yeah, absolutely. And in today's world, you might know that there's a few people moving from the Northeast to Georgia and Florida because that's why your business is booming. Mm-hmm. So, we have many people who buy properties in different areas where we match them up with credit unions in the local marketplace.
All right. Anything else that you want to share or anything to educate audience, maybe kind of towing their water into this LLC's lending for the first time and using a credit union?
Yeah, really be organized and treat it like a long-term relationship because that's how we look at it. If you just want a one-off transaction, hopefully you can consider us. But, we really want that long-term relationship to grow your business.
Awesome, Mark. Thanks so much for joining the House of AAC. What's the way someone can reach out to you?
Easiest way is markritter.com and connect with me on there. Or we're very active on LinkedIn, Member Business Financial Services, or myself. Feel free to direct message us on there, and we'll connect and get the process moving.
That's awesome, Mark. Guys, if you're listening, I'm telling you, financing and your tools of financing are so important for growing your business. You've got to know who to go to: residential side, commercial side, hard money side, personal capital, friends, personal investment, friends and family. Know where you can get this capital to grow your business. And no one's just going to give you money because you ask for money. You have to show a business plan, right? That's the same if you're, trying to attract partners, but your lender is always going to be your biggest partner in every transaction. Know as many people, know what's out there. Mark Ritter, thanks so much for joining us, educating us on credit unions and the commercial side of real estate investing, financing. Appreciate it so much. I've learned a ton, and I know our audience has as well.
Thank you, Alan, for having me.
Sure, no problem, Mark. And guys, please like and subscribe to House of AC. Follow the House of AC on TikTok, Twitter, Instagram, LinkedIn, everywhere. I'm trying to grow my social media profile. Your follows, your likes, your comments help me do that. Thanks for tuning in to the House of AC, guys. See you.